In today's episode, you have an opportunity to learn from the mistakes that I made trading a stock that went up over 4,693%. And so what I want to do is I want to be very simple, very concise, and give you 3 tips that you can implement in your trading to help yourself not fall victim to FOMO, to help you not buy the top of these moves, to help you avoid getting caught in circuit breaker halts. And I also want to teach you a few lessons on how to find these types of stocks before they make the big move, so you could be trading the beginning of the front side and not chasing it after it's already made the move. Today was also an example of a day where we had FOMO, MOMO. We had a lot of momentum that was sympathy to the primary stock that made a big move. It was a clinical stage biotech company from California that put out news this morning updating a data from a study that they're conducting. And the results were positive as the stock went up over 4,000%. But there was so much more than that. The sentiment in the market right now and today was super, super strong. And that's why through the day, we saw several stocks go up not just 100%, but over 500%, some of them with no news at all, which can be hard to wrap your head around. So we've got a lot to cover in today's deep dive. So let's get onto the screen share and jump right into it. The biggest mistake that I made trading this stock today was getting too aggressive trading it as it was getting into these extensions. See how high it was getting? We had these big extensions, but then these dramatic reversals. So it was like, this is a stock that it's crazy looking at this chart, how high it went. It started at 20 cents a share and went up to over $11 a share. 11.50 was the high. But look at how dramatic these moves were. You know, when we're zoomed out, maybe they don't look so big. But if you got zoomed in and you were trading it in these moments here, you know, this right here goes from $2.50 to $5 back to about $3.70. You know, these are big pullbacks. And for a lot of traders, these are places where it's very easy to get trapped and get stuck. And that's exactly what happened to me. I got too aggressive buying near the tops. And then what happened? I got stuck in circuit breaker halts going down. Now, the way I found this stock to begin with, high level, was using my scanners. So this morning, I pull up my scanners and I saw that TPST was already up like 300% at 7 a.m. So I was like, okay, we've got a stock that's making a big move. And from there, I just pulled up the chart and I was like, okay, where can I start buying this? I realized pretty early on that it was a biotech stock with news, but that it was sort of, the news was funny in that they put out news that news was coming. But that news was released this morning. And when that came out, that's when the volume really came in. So for me, I did well trading it in a couple of different areas. My first trade was at about $1.10, right in this area. And we got to move up to about $1.20, which was good for a small winner. It sells off, it comes back up. So kind of dramatic move right there. This was sort of already showing us that this is a stock capable of faking people out. And then right in this area, I bought 20,000 shares, and right into this candle, I got myself up about $10,000 on the day. So if we zoom in here, what we see is a stock really that just started to pull away. And this was where the first round of short sellers got blown out. They got squeezed out as the stock was going up now 500, 600, 700% on the day. And you have to recognize that if you shorted this stock with $10,000 this morning when it was at about $1 a share, you could have lost over $100,000 today. Whew, that's crazy. Now, similarly, if you had bought $10,000, you could have made $100,000, and I didn't make $100,000. So it's always easy to say in hindsight how much you could have, would have, should have. But the thing that I really want to highlight on here is that this is the type of stock that is a nightmare for short sellers, because a stock going up 4,000%, it highlights the fact that when you short a stock, you have unlimited losses because you have to buy back your shares. So if you short 10,000 shares at $1 and it goes up to $2, you're down 10,000 bucks. It goes up to $10. Now, all of a sudden, you're looking at 6-figure losses. And the biggest issue for me with this stock was the halt levels. So let's pull out the whiteboard here and talk about these circuit breaker halt levels, because this poses a real risk. So number one, we're going to be talking about FOMO and how to avoid buying tops. But number two, I want to jump to this just for a second, halt levels. So the problem with these types of stocks is that they trade in very narrow volatility bands. So because of the price of this stock at the open, it was halting. I believe it was every 10% going up or down. And so when it was trading at $2 a share, if it went up to 220, it would halt up. If it went down to 180, it would halt down. These circuit breaker halts are designed to protect retail investors, institutional traders from volatility, protect from flash crashes. But this is an area where I'm not sure that they're doing the intended purpose, because what you can see on the chart is how the stock gaps. So just right here, for instance, this is a really interesting spot where the stock halted going up right here. It halts going up at about $6.30, and it opens at $7 a share. It gaps up 10% during the halt. And if you were short, what could you have done? Nothing. There's nothing you could have done to control your risk there. It then opens, halts immediately going up. Within 10 seconds, it's halted again. And then it opens and halts a third time. So this stock basically went from $6.40 pretty much up to $9, and then right up after hours to 11, going up over nearly 100%. And it would have been very hard to manage your risk on that type of trade. But even for a trader on the long side, some of these halts to the downside, right? You get a halt down like this one right here where it halts down. So now we're getting a halt down right here. It halts down a second time. It halts down a third time. I mean, you're looking at a 50% drop in a matter of, 3 candles through circuit breaker halts. So how are you supposed to manage your risk trading these types of stocks? I think that first of all, you need to look at this type of stock as clearly an opportunity. This is a huge move. Big moves like this, we love them because look, my goal, if I can grow my account by 10% in one day, I'm thrilled. That's a great day. So if you have a $5,000 account, you make $500 in one day, that's a great day, right? You're not going to make 10% in one day trading a stock that's going sideways, right? You trade Bank of America, you trade Sirius Satellite Radio. These are stocks that they go sideways. So, there's no move there to make money on. Now you have a stock like this, there's a lot of opportunity to make 10% on it. You could make 10% probably about 100 times, but it also becomes difficult to manage risk. So one of the things that I learned over the years is the importance of knowing when to walk away. And on that today, I failed epically. So I started the day going up $10,000. And as I showed you at the top of this candle right here, I was up 10 grand on the day. So right there, I was up $10,000. And then here's where I made the rookie mistake. So going into the open, I bought, I think it was 15,000 shares or so. And I was looking for a squeeze through this pre-market pivot here for a break at the pre-market high and a move up. Well, what ended up happening on this was it halted down at the open. And just like that, it's amazing how quickly it can happen. I lost about half of my profit on the day. Here's a rule of thumb. Learn from my mistake. So we're going to flip this over. Well, this was from last episode. So we'll just do it here. It's fine. So rules to live by. Number 1, give back half your gain. Time to walk away. This is me walking away. All right. That's me walking away, holding your little briefcase and getting the heck out of town. Stop trading if you give back half your profit. Because what happens is once you've given back half, you know what you're going to be? Emotionally triggered. I know because it happened to me today. But for some reason today, even with all these years of experience, for some reason today, even though I had already given back half and I was up only $5,000, I said, I'm going to take one more trade. I took one more trade. You know what happened on that trade? I lost 7 grand. I brought myself from up 5,000 on the day to down about 1,700. That is now, if the time to walk away wasn't when you gave back half, it's when you go red on the day. It's when you go red. Now, I stopped trading and I walked away. The stock ends up squeezing And I was doing some other work, working on another episode that I'll upload to YouTube shortly, later this week. Ends up going up to $2.50, goes up to $3, and now I'm livid because I see that and I'm thinking, you are a loser. I can't believe you're the guy who sold at the bottom down here only for this stock to go all the way back up to 3. Then it goes up to 350 to 4. It goes up to 5. And then I had to run an errand. So I go out, I run an errand, I come back. And while I was out running errands, you know what I was doing? Rookie mistake. I was checking the stock price on my phone. Rookie mistake. Let's put another rule here. Delete mobile app. In fact, take your phone, this little guy right here, and throw it away. You don't need that thing anymore. Not on a day like the day I had today where you're feeling FOMO, where you're feeling frustration. You got to stop looking at your phone. You got to stop looking at the market. Learn from my mistake. I didn't do that. I ended up coming back. And as we went into after hours, we halted going up. And I said to myself, I'm going to buy right here in after hours. And I bought this at $10 a share. And I made $2,500. Was it a good trade? It was an okay trade, but it wasn't a great one. Because you know what I did next? I added back up here at 11, and I gave back the profit I made. So I'm now up on TPST $700, and then I started trading a few other stocks. As this started to drop, I took one more trade on it, and I actually sent myself from a total swing of up $10,000 on the day to down $7,000. That's a big swing. And then I got back in TPST right here, and I got back in at $9. I added at $9.50. And you know what I said to myself? I said, I'm getting in at $9 or $9.50. I'm going to add at 10. I'm going to add at $10.50, and I'm not going to take profit until it breaks $11 a share. I did that, and on that trade, I made $5,000 as it came back up here to 11. Thank God I didn't say I won't take profit till it hits 11.50, because it never hit 11.50. And then it ended up selling off. You know what? If I go back to the very beginning, where did I break the first rule? The first rule I broke was continuing to trade after I gave back half my profit. Because if we look at that trade that I took early in the morning, it was back here at, right going into the open, whatever this was. Now I've lost my place here. So going into the open, we'll get this back up here one second. So going back into the open, here it was. Yeah, so right in this area here. Maybe you could say I was a little too aggressive. Maybe on this trade I was a little impatient. But you know what? You have to step up to the plate. You have to take risk if you're going to make money trading. And in this case, I took a little risk. It didn't work out, and that's life. So the right thing to do here was just to walk away with half of my profit and be done. But what happens so quickly is you give back half. Then you go red. Then you forget to delete your mobile app. And then you're down, minus 5K or minus 7K or minus 10K. And now you're at your daily max loss. And now what are you doing? Hail Mary. This just turned from a list of rules to a list of things never to do. But I say never. And as a trader who's been doing this for a long time, and some of you may have also been doing this for a long time, you know how easy it is to fall into tunnel vision, to get sucked into the moment. And next thing you know, you're spiraling. And this happens. This could have been a day where I finished down $15,000. That could have happened. And that would have been disappointing. It wouldn't have been the end of the world, of course, but it would have been really discouraging. Today, I just through probably a degree of educated intuition, but also thank some luck, probably, I ended up coming out back into the green. It's lucky that happened. It won't happen for most, but I think this is why I wanted to share this with you, so you could learn from my mistakes, because for most people, you won't end up coming out on top. You'll make these kinds of mistakes and you'll give back half, you'll go red, you forget to delete the mobile app, and the next thing you know, you're deep in the red. So I share this with you as these are real things that happen. So how do you avoid falling victim to FOMO? Because on the one hand, when you have a stock making this kind of move, right? So this went from a low of 20 cents all the way up to $11 a share. And then what also started happening was we started getting what's called sympathy momentum. So I'll just show you for a second here a couple stocks that went up on sympathy momentum. OPGN. This is a stock here that went from 40 cents a share to $2.60. It went basically straight up. All right, that was crazy. Then we had SECO, SECO. This one went from 40 cents to $3.80. This is sympathy momentum. We had YJ. So when the market gets hot, you start having these back-to-back-to-back squeezes. I think it was YJ. Let's just double check the chart. Yeah, this went from about 50 cents a share also to about $2.50. So we got like 4 of these this afternoon during after hours trading. And the result is if we look at our scans, we look at our top gainers scanner, you're going to see today that we have 1, 2, 3, 4, 5 stocks up over 100%. Are these the right type of stocks to trade? Well, I think the answer is it depends on your skill level. These aren't going to be the right stocks for everyone to trade, but these are the stocks that I like to trade. And if I show you, I could just give you my recent, 90 days here. So, these are the stocks I've been trading just over the last 90 days. There's about $150,000 of profit. I have red days from time to time, maxing out about 10,000, averaging about 5. And, I have nice sides green days from time to time, of course. These are the stocks that I like because when you have this much volatility, for me, I find it easier to capture my, 10% a day, whatever you want to, 10 cents a day, 10% a day, 20, 30 cents on a stock like this, it becomes easier. But the reality is, for me, the easiest trades were pre-market and after hours. Why? There were no circuit breaker halts pre-market or after hours. So I wasn't getting caught in halts. So today I made my money between about 7 a.m. and 9:30, and then between 4 p.m. and it's about 6 p.m. now. So after hours. That was the window where I did better because unfortunately the halts on this one were just unmanageable. And even as I was watching it in this area, once I got back from running my errands, I was like, I wouldn't be trading it right in here. These halts, they happen in an instant. So what was happening was the stock would be showing it would be 590 halt down, and then it pops up to 620 and it's at the halt up level. I mean, it was maybe not quite that tight, but it was the halt levels were so tight, it would be at the halt level down, and then a burst of buy orders would go through and it would be at the halt level up. And I found that extremely difficult to manage my risk. And unfortunately, that's where I gave back my profit because I got caught in a halt and I couldn't unwind the position until resumption, but it gapped lower. The reason stocks gap higher and lower during halts is because of the order imbalance. So people want to sell, they press the sell button, and then when it resumes, it has to match the new buyers and the new sellers. So when they go halt down, they open lower, typically. When they halt up, they open higher, typically. There were a few exceptions to that today on this one, but that's generally what happened. So the best thing you can do to avoid getting caught in halts is to be very cautious trading these stocks during regular trading hours when we have halts, because we don't have them pre-market at all. The next thing you could do is you could carefully watch where the halt levels are, which if you subscribe to market data, depending on which broker you use, you're able to see those volatility bands. So with those volatility bands, you can see very clearly the halt up and the halt down levels. So you can kind of at least understand where they are. But in this case, it was hitting them so fast, there was no way to avoid getting caught in them. It was very difficult to, at least. To avoid buying tops, this is a tough one because the fact is, my entry up here at $10, which was a good trade in a way for that after hour squeeze, that was high of day at that moment that I got in. When I got back in here for the curl, that was a safer trade. So if you're a beginner trader or even you're an experienced trader, but you're not feeling totally confident, focus on the curls and avoid this leg up. Now, this is counter to what I usually would say. Usually I would say focus on the leg up, but when you're getting these circuit breaker halts back to back, it's hard to get in midway into this ramp up. And it feels like it's easier to wait for a pullback and take the curl. So focusing a little bit more on curls, avoiding trades right at the high of day. And then, I think in terms of FOMO, if you're feeling yourself getting frustrated, and I'll just give you an example. Let's say you just lost $5,000 and you pick up a cup like this and you're about to throw it against the wall and you're having to hold your arm back. That might mean you have FOMO. And listen, that's not something that would ever happen to me. But if it were to happen, it would look a lot like that. That's a time to walk away and say, you know what? At least I still have what I have. My dignity, perhaps. A little bit of profit still for the day, perhaps. This is the time to walk away. Today for me was a setback. While you could say all's well that ends well because I finished green, it's a setback because I let myself get very, very frustrated, and I never like to let that happen. But it happens to the best of us, and so this is life. But the thing is, once you get emotionally hijacked, you're gone. That's the biggest problem. You can come back tomorrow and be like, what was I thinking? But once you get that angry, once you get that reactive, you can get very reckless with the way you trade. And that's the truth. That's the reality. So if you can learn to identify your triggers, the second you spot a trigger, man, your window's already closing to walk away. Your window, when you realize you've been triggered, your window's already halfway shut. And you better get out real quick, because if you don't, you can start to snowball the way I did today. I want you to learn from these mistakes. I want you to look at stocks like this and see and recognize the very real opportunity that they present. And you can capitalize on FOMO in the market with some of these other stocks that make sympathy moves. There's nothing wrong with that. But if you find yourself, for whatever reason, getting triggered, that's the place to walk away. I had an opportunity to do it today with respect, with dignity. When I was still at $5,000, I screwed that up. And I'm walking away today after a real roller coaster of a day and a real emotional setback. And I think that that's avoidable. If you found this episode interesting, I do hope you hit the thumbs up. I hope you subscribe to the channel and check out this episode that YouTube thinks you just might love. It's right there.